Investment experts always advise us to buy stocks at a low price and then hold on to them. We're told to keep a stock until there is a clear reason to sell, such as the stock price gets very high, you need the money, or the company's core business deteriorates. There is nothing wrong with this advice after purchasing a stock. However, what options do we have besides passively holding on? A covered call is something active we can do. It consists of buying a stock and selling a call. It is a prudent and conservative strategic option that retail investors can easily pick up and put into practice. There are two purposes for a covered call. One is to increase the return of your portfolio over the long term, and the other is as a means of creating profit. Either way, as long as stocks do not rise sharply in the short term, using a covered call allows us to earn more than we would by merely holding the stock passively. So what is a covered call, you might ask? First, we need to know about stock options. There are two types of stock options, call options and put options. If you hold call options, you will lock in the buying price at a specific time. If you hold put options, you will lock in the selling price at a certain time. This is the equivalent of promising a minimum purchase price. This makes it seem like the options buyer has only rights with no obligations. Doesn't that sound great? But it's not free. The right is only given in exchange for an option premium. The option premium is the money that the option buyer has to pay the seller. So what determines the level of this premium? The closer you lock your buy price to the current price, the higher the premium. Say a kilogram of apples currently costs $5. You say you want to lock in a $5.10 buy price and a $4.9 sell price. Say another person wants to lock in a $10 buy price and a $1 sell price. You are much more likely to make money, so naturally you will pay a higher premium. The $5.10 and $10 prices here are referred to as the exercise price. This raises the question, if I want to lock in the same price for next month and for next year, which will have the higher premium? A one-year option is the more expensive choice. The sell-by date is the exercise date, also known as the expiration date. The later the exercise date, the higher the premium. There are two possible situations here. One is where I, as the buyer, can exercise my stock option at any time before the exercise date. This is called an American option. The other is where I can exercise only on the exercise date. This is called a European option. Individual stock options are usually set as American options, while index options are usually set as European options. The last factor is volatility. Which option do you think is more expensive? Intuition tells us it is the second. The higher the volatility, the greater the probability of an option being exercised, so the premium is naturally higher. To sum up, option premiums are affected by the current stock price, the exercise price, the exercise date, and the stock's volatility. This raises another question. If the stock price does not exceed the exercise price when it expires, the options become worthless. So why are people willing to pay these premiums? Because of leverage, using a small sum to bet on a big win. This is an example of an option for Microsoft. Microsoft currently trades at $294.85, while the exercise price is $295, which is slightly higher than the current stock price. The official term is slightly out of the money, OTM, and the exercise date is 21 days later. The premium for a share is $7.18, and an option corresponds to 100 shares. In other words, as long as you pay $718, you can control 100 shares of Microsoft within 21 days. It costs $29,485 to buy 100 shares normally. The leverage in this trade goes directly to 41 times. This will prompt many to try their luck. While some may strike it rich, most will lose money. The probability is already reflected in the premium. The exercise price is $295, and you pay an additional $7.18, which means that you can only make a profit if the share price rises above $302.18 in 21 days. How likely is that? Think about it. If the option buyer is not likely to make any money, why should we not be the seller? Well, you just never know. Once a stock price soars, the loss of selling a call is unlimited, and you also need margin to guarantee any possible payout. So most people do not dare to use such a strategy. A covered call is different. It sells a call with the stock itself as the guarantee. The advantage of this is that no matter how high the stock price rises, you will not lose money. The worst case is that the stock is sold to the other party at the exercise price. This means that covered calls are suitable in 3 situations. The first is where one holds onto shares for a long time. The second is where one predicts that the stock price will trade sideways or rise sharply in the near future. The third is where one wants to cap the profit from the stocks they hold and earn extra premiums at the same time. This is the yield curve. Another advantage of a covered call is that it does not require extra margin. It must be emphasized that this is an advanced function involving the self-clearing of options, which is not supported by all securities companies. So far, we already know that the risk of a covered call is very low. What are the benefits then? Let's look at forward shares, which are substantially cheaper. Suppose we spend $1,489 to buy 100 shares at the closing price of $14.89. We then predict that the share price will not rise above $16 in the next month. If it does rise above $16, we can sell it at $16. Next, we sell a call with an exercise date of November 5th, an exercise price of $16, and a premium of $29. On November 5th, if we made the correct prediction, such as the share price does not rise above $16, regardless of fluctuations in the share price, our profit from the premium is $29, with an annualized yield of 1.9%. In less than 1 month, the yield is 1.9%. If the prediction is wrong and the share price soars to $17, then unfortunately, we will only earn that part of the profit, less than $16, plus the premium. The stock return is $16 minus $14.89 times 100, which equals $111, plus the $29 premium is $140, which is equal to 140 divided by $1,489, which equals 9.4%. It is an excellent return in less than 1 month. Of course, we must remember that if the stock price falls, the loss is difficult to make up with the option premium. Fortunately, the stock may rise again after suffering a temporary decline. As long as the call is not exercised and duly expires, the premium will go into the investor's pocket every month, which means a stable cash inflow. This sounds similar to collecting rent, doesn't it? To sum up, the covered call strategy is suitable for stocks with low price volatility. If used properly, you can earn extra cash every month without taking too much risk. I hope this video will help you get started with stock options. Subscribe to my page and learn more about investing with options.